Hello, welcome everyone. We are so pleased to welcome you to today's webinar on Redefining Financial Vulnerability in Canada, hosted by Prosper Canada. We will begin shortly and hope you settle in and join us for the next hour for an interesting and informative presentation. Before we begin, we'd like to share some logistical information for this webinar. Please note that everyone in the audience has been put on mute. Presenters will be joining you using audio only, but you will be seeing their presentation slides projected on the webinar platform. Please share any questions and respond to questions posed by panelists using the question box function located in the GoToWebinar control panel at the side of your computer screen. We will be holding a dedicated question and answer period at the end of this webinar, but you're welcome to enter questions in the question box at any time during the presentation. A downloadable PDF of the slide deck is available in the handouts section of the GoToWebinar control panel and will also be emailed to all registrants in the days following the presentation. This webinar is being recorded. A link to the recording will be shared on the Prosper Canada website and emailed to all registrants in the next few days. Please feel free to share this information and this recording with any friends or colleagues who may benefit from the information shared in this presentation. We'd like to begin by acknowledging that Prosper Canada is located in Toronto, which is situated upon traditional territories. The territories include the Wendat, Anishinaabe Nation, the Haudenosaunee Confederacy, the Mississaugas of the New Credit First Nations, and the Métis Nation. Toronto is in the Dish with One Spoon territory. The Dish with One Spoon is a treaty between the Anishinaabe, Mississaugas, and Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect. Today, the meeting place of Toronto is still the home to many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We'd like to acknowledge and thank everyone on the line joining us from traditional territories across Turtle Island. We are honored to be having this conversation with you, and thank you for taking the time out of your day to join us. This webinar is hosted by Prosper Canada. Founded in 1986, Prosper Canada is a national charity dedicated to expanding economic opportunity for Canadians living in poverty through program and policy innovation. As Canada's leading champion of financial empowerment, we work with governments, businesses, and groups to develop and promote financial policies, programs, and resources that transform lives and foster the prosperity of all Canadians. We help service systems and organizations in all sectors to build proven financial empowerment approaches into their businesses in ways that are sustainable, help them achieve their goals, and tangibly increase the financial well-being of the low-income people they serve. For today's webinar presentation agenda, we will introduce our knowledgeable and experienced panelists. We'll then move into the presentation on why there is a need to redefine financial vulnerability in Canada. What are the issues with the way financial vulnerability is conceived and currently addressed in our country? Our first two speakers, co-authors of the book Financial Vulnerability, The Embedded Experience of Households, will be discussing their research on financial vulnerability as a threat to financial well-being. They'll dive into scenarios that highlight the need for change and make recommendations to policy and financial counseling supports. We will then follow this with commentary on this issue from a practitioner and program delivery perspective, where our third speaker will discuss real-life examples as experienced on the front line with clients and people living in financially vulnerable situations. A question and answer period will follow the panelist discussion. We are thrilled to be joined by our three panelists today, Jerry Buckland, Brenda Spotton Visano, and Margaret Yu. Jerry is an economics professor at Canadian Mennonite University's Redekop School of Business and a professor of international development based at the University of Winnipeg. He specializes in financial ecosystem studies and regional and community development. He has authored many articles and books in these fields, including co-authoring with Brenda the book Financial Vulnerability in Canada, The Embedded Experience of Households. With a team of researchers, he's working on a 6-year study, the Canadian Financial Diaries, exploring the financial dynamics of people with low and modest incomes. Welcome, Jerry, and thank you for joining us today. Brenda is a distinguished university professor in economics and public policy at York University, Canada. Her community-engaged, policy-oriented research focuses on advancing access to financial services, analyzing funding frameworks, and enabling access to higher education by non-traditional students. Her research projects seek to strengthen financial accessibility through policy development, institutional change, and financial literacy education. She's the author and co-author of many scholarly articles and community-focused reports for governments, First Nations organizations, UNESCO's, and non-government organizations. And as mentioned earlier, she recently published a book together with Jerry titled Financial Vulnerability, The Embedded Experience of Canadian Households. Margaret is a registered social worker and an accredited financial counselor of Canada. She's been with Momentum since 2014. Momentum is a change-making organization that combines social and economic strategies to reduce poverty. As a financial coach, her mission is to change and improve the way we talk about money that all Calgarians and Canadians feel good about. Welcome, Brenda, and welcome, Margaret. And I'm Carrie Wong, Manager of Learning and Training at Prosper Canada. I'm responsible for leading learning and training strategy initiatives, including the development and delivery of financial empowerment training and resources for organizations supporting financially vulnerable Canadians. Prior to joining Prosper Canada in 2019, I worked for 10 years in the public and private education sectors, overseeing training and development of frontline staff and educators. So welcome to all of our speakers. We're so excited to begin, and we'll move on to the presentation portion of this webinar now. So in the first portion of our presentation, Jerry and Brenda will speak on financial vulnerability in Canada. Jerry, I will now hand the presentation over to you.
Thank you so much, Carrie. Wonderful to be here. And I wanted to start off the presentation that Brenda and I are sharing today, the topic being redefining financial vulnerability in Canada. Next slide, please. The objective of our presentation is to demonstrate the limitations of the conventional way in which financial vulnerability is conceived, to expand on and strengthen this conception in order to more effectively address all types of financial vulnerability. In addition, we want to get your feedback, so along the way in our presentation, we have several questions that tie in with our work. Next slide, please. The presentation is broken into these 5 things. So I'm going to start off with the, well, I'm introducing it, and then Brenda will be talking about the problem. We'll be talking about the need to broaden the conception of financial vulnerability. We're going to share a scenario that brings this to light, and then talk about policy implications. Next, please. Brenda and I have, as Carrie mentioned, recently published the book Financial Vulnerability in Canada, The Embedded Experience of Households. And this book seeks to do a number of things. In my mind, it's sort of the beginning of my studies with respect to financial vulnerability. There's a lot more work to do, but this book was just an awesome project, and I'm so grateful to have worked with Brenda. And one of the things that we did was to work at understanding and broadening the conception of financial vulnerability by assessing common views about financial vulnerability and exploring various literatures that examine financial vulnerability. Next slide, please. And we relied on a number of sources for data for this book, including nationally representative survey data. Brenda worked tirelessly on looking at those data and finding the meaning with respect to financial vulnerability. And then also we integrated these insights with insights from the Canadian Financial Diaries Research Project, which is a project that looks at a small group of Canadians in a very in-depth manner. And we juxtapose financial vulnerability with the concept of financial well-being. So that's another thing that we'll make reference to in this presentation. Next, please. And I'm going to hand it over to Brenda. I think we just need to open Brenda's microphone.
Thank you, thank you. Thank you, Jerry. Greetings, everyone. I add my thanks to you and especially to Prosper for this opportunity. Our ultimate goal in this book is to understand which policies can help modest income Canadians and which policies may be hindering their money management. We know that how we define financial vulnerability matters for how we design policy. Currently, consumer finance policies in Canada focus primarily on those consumers with too much debt. In this next section of the presentation, we want to briefly unpack some of the problems with this narrower or operational definition of financial vulnerability. Next slide, please. Of course, too much debt can cause considerable financial strain, but is too much debt the only way people experience financial stress? First off, financial vulnerability as too much debt omits the experience of people without debt. Are they not feeling financially stressed? Could it be that too much debt is an outcome of financial difficulties caused by other barriers to managing money and building their financial resilience? Is there anything else we should be looking at? Next slide, please. Policies to constrain consumer debt have focused on regulations to limit mortgage debt, primarily, since most of the consumer debt that we track in Canada is mortgage debt. The problem here is that 3/4 of the lowest income Canadians do not own their own home and so don't have mortgage debt. And while we track mortgage debt and credit card debt very closely, we have no national data on payday loans, installment loans, and other high-cost consumer debt. So even within the restricted policy focus, we're missing critical information. Next slide, please. In addition to policies designed to constrain consumer debt, the government is promoting financial literacy. That is great. But if weak financial literacy skills are not the cause of too much debt, better money management will not be the solution. We need to consider how and why Canadians got into debt in the first place. Next slide, please. From an equity perspective, Jerry and I believe it should be at least as easy for modest income Canadians to bank as it is for higher income folks. And it should cost the same. But it's not as easy and it doesn't cost the same. In Canada, it's expensive to be poor. Higher income Canadians can borrow from a bank at 4%, but lower income Canadians forced to borrow in the fringe market pay in excess of 300% interest. As another example, higher income Canadians who maintain the minimum bank balance of $5,000 pay no bank fees. Canadians without an extra $5,000 to spare pay $1.95 per transaction. Money in, $1.95. Money out, $1.95 every time. Next slide, please. Our aim then is, as Jerry has mentioned, to widen the lens on financial vulnerability. We're seeking a broader conceptual definition to include Canadians without debt as a way of thinking and framing the policies we consider. We're seeking here to capture more of the experience of Canadians, particularly those with modest income. Next slide, please. Our aim then is to better understand the many different ways in which Canadians experience financial vulnerability and stress, to better reflect the breadth of financial struggle. Once we understand this, we'll be in a better position to understand how much of that financial struggle is within the control of the individual, and so would benefit from greater financial education, for example, and how much would benefit from better government or bank policies. Our starting point then is to define financial vulnerability as the risk of a personal financial crisis, high stress, or bankruptcy that threaten well-being. But what does this mean on the ground in the day-to-day experience? I turn it back to you, Jerry.
Thank you, Brenda. And going back to the Canadian Financial Diaries Research Project, which I mentioned was a project that's digging deeply into the finances and financial lives of a small group of people. Phase 1 involved 28 people that we met with weekly or bi-weekly for up to 1 year. We are now undertaking phase 2, which is involving just over 50 people for a 6-month period. Through this diaries research project, we have learned so much with respect to people's finances, both quantitatively, but also how they understand their finances. And one of the real benefits of a diary process is that it enables the building of trust between interviewer and participants so that better understanding is enabled. So that qualitative sort of dimension of the diaries project has really enabled us to understand the perspective of people in the project. And phase 1 was almost exclusively people with very low incomes. There were some modest middle income folks, but many were living well below the poverty line. All of them at least began in Winnipeg. A couple of them moved over the course of the year. Phase 2 is a broader cross-section of Canadians from a number of communities. So we learned about financial well-being, we learned about financial vulnerability. So just some thoughts with respect to financial well-being. What did our participants say it meant to them? If they were financially well, what did it look like? Well, it meant that they could easily meet financial obligations, that they felt secure in their finances in the future. Very clearly, participants saw their finances in a holistic way, and their finances were a part of a series of assets, social, personal, livelihood, for instance, employment assets that people draw on for both financial well-being, but then also well-being in life. And another thing participants emphasized was the desire to make choices about what they wanted in life, and that this was an important feature of financial well-being. Next slide, please. On the other hand, financial vulnerability, we heard from participants involved a few features. First of all, liquidity stress, that people just didn't have the money to make ends meet on a daily basis, weekly basis, monthly basis. Another feature of financial vulnerability was a sense of insecurity about finances. Will I have that job next month? Will I get my hours of work next month? Will I be supported by friends and family next month? So this sense of financial insecurity. And then anxiety was an important feature, and also trauma. We definitely saw the impact of trauma on people's financial well-being and how it led to vulnerability. Next slide, please. And what we saw were principal causes of financial vulnerability were not necessarily high debt, because, as Brenda's already said, people with low income, in some cases, they can't get debt. They can't get credit, at least not formal credit. Some do, and that can be a problem, but for many of the participants, they didn't really have debt, but what they did have was low income, and that low income in some cases was precarious, that it was higher one month and lower the next, and this led to a mismatch of income and spending. So people, just have enough to get by, if that, and it's not matched well. Oftentimes people don't have a savings cushion, they don't have money to draw on, and that's where the social feature comes in, where people will have lending, borrowing, gifting circles with friends and family. But we also saw that can work both ways. It can support people, but it can also, in some cases, harm them if they're the one who gives all the time. So savings cushion is very important. But we also wanted to say that consumer knowledge, psychology, and behavior are of lower order importance, that we saw people making good decisions based on the limited finances they have. They're doing everything they could, not all the time and not all people, but most of the time, and most of the participants were doing everything they could. And it wasn't a question of, well, you just need to understand more. No, it was a question of the need for higher income, the greater matching of income and spending, and the need for a savings cushion. And I think the next slide then leads us to a question, and I'm going to hand it over to Carrie.
Wonderful, thank you, Jerry. So Jerry and Brenda would actually like to hear from our audience. We have a question that we will launch a poll momentarily. And the question we would like you to answer, and you can select one of the following responses. For those of you familiar with Canadians struggling to manage on a low income, is this conception about financial well-being and vulnerability helpful for you in your work or in understanding the issue? So select yes, no, or mix. And I'll just wait another 10 seconds or so for the responses to come in. Closing in 3, 2, 1. And here are our results, that 82% of you answered yes, this conception is helpful, and 18% of you answered mixed. So if you're interested to elaborate a bit more on your answer, if you've answered mix of yes and no, please feel free to go to the question box. You can insert comments there as well, and then throughout the presentation, we will be highlighting some of those comments or sharing those questions with our presenters. So at this point, I will turn the presentation back to Brenda, who will take us through to the next topic.
Thank you, Carrie. To get a better feel for the day-to-day decisions confronting someone living on the financial edge, we took a closer look at a possible real-world scenario. If I'm a low-income renter with no savings cushion, who faces a sudden necessary expenditure of $500, for example, a car repair, and I need the car to get to work, or I need the car to conduct my work. What can I do? How do I manage? Next slide, please. Without a friend to borrow from, as Jerry had mentioned in the social network, the choices I face are: 1, try to pay the $500 from my checking account. But if I overdraw, the check will be returned for insufficient funds and the bank will charge me a non-sufficient fund fee. Option 2, choose to forego a payment of another expense, such as a utility bill. But if my utility is disconnected, I'll be charged the reconnection fee at some later date. Option 3, I could try to pay by credit card if I have room. But if I'm already overdue to the bank on my credit card payments, I'm at risk of the bank withdrawing the money I owe them without notice and without my permission. This stems from the bank's legal right of offset. My fourth option, I could borrow from a payday lender. Next slide, please. We then did the calculations. The non-sufficient fund, the NSF charges, are $48 on average at most banks. And the payer has an option, a legal option, to try and collect on the check a second time. So the NSF charges could be as much as $96. The reconnection fees are $120 if it's electricity and you live in Toronto. The bank's right of offset could cost me even more than the $96 on one NSF check, because any checks and automatic withdrawals taken from my bank account after the bank has drained it will incur those NSF fees. The payday lender, however, in Ontario, will only charge me $75. Next slide, please. Of course, the loan from the payday lender is only 2 weeks, but stressed as I am only able to cope with today's problem. Tomorrow's problem is for tomorrow. In this scenario, my financial stress is not due to too much mortgage debt, of course, and it's not due to weak financial literacy skills. In this scenario, my financial hardship is due to the low income, to an unexpected expenditure, to excellent trade-off thinking, but under stress, it is my tunneling, my coping with today's problem only that gets me into trouble. I'll turn it over to you, Carrie, for a couple of audience questions, please.
Thank you, Brenda. So we have a couple more questions for our audience. And this one is, why do you think some Canadians with low income have difficulty focusing on longer term financial situation? And for this one, you can select one or multiple responses, select all that you think apply. So the first is tunneling, which is when a person tends to focus on selective or narrowly defined category of information just due to limited bandwidth or the demanding nature of a task. So that's one aspect. Another aspect might be stress. The third, lack of understanding or weak financial literacy skills. And then fourth is other, if you think there is a combination or another reason. And you can provide details in the question box and insert your comments there. So I see many responses coming in, and we'll just keep the poll open for another 10 seconds. And I'm also seeing other comments come in as well, that other might be lack of community or family support, perhaps focus on meeting more immediate wants or needs, past experience with trauma or learned behaviors, a lack of good options, and many more responses coming from our audience. So we'll close the poll now in 3, 2, 1. And sharing our responses, the highest selection was, many people think this is due to stress with 79%, followed very closely by tunneling. More than half of you thought that it was due to lack of understanding or weak financial literacy skills, and then 27% stated other. So let's ask our audience one more question. And for this question, we'd like to ask, do you think Canadians with low income who use payday loans and other high cost services are comparison shopping and thinking in terms of money trade-offs? Yes, you do think so, no, or mix? Okay, response is still coming in. Close in 3 seconds. 3, 2, 1. And almost equal amounts saying no or mixed, and with fear of you 13% saying yes. Okay, and I turn it back over to Jerry, who will share a bit around some policy and counseling recommendations.
Thank you very much, Carrie. And very briefly, Brenda and I actually did quite a bit of thinking and work on policy recommendations from our research, but we want to focus on really sort of 2 issues, and that's the issue of access to basic banking, and then the issue of how do we prioritize financial literacy. So first point is we see the need really to rethink and revise and update access to basic banking regulations. Those regulations came, I think, in the 90s and had relevance then. What we need to do is we really need to revamp them. And this is based on what we're seeing both in the Diaries project and also in Brenda's work looking at national surveys, that there are people who are falling through the cracks. They're not getting access to banking, and they're facing, as Brenda's called it, this poverty penalty. And so we need to work at ways to eliminate that poverty penalty and banking fees and make the cost of basic banking services equitable. So there are a number of things that we could talk about if folks have questions about that as to how this might be done. But we really need to reconfigure that, especially with the the online and the mobile options in terms of banking. We need to eliminate the bank's right of offset, which Brenda's already explained, and require banks to extend some form of low-cost credit so that Canadians with low income and limited opportunities aren't having to go to payday lenders or other subprime lenders. Next slide, please. And then the final point is with respect to financial literacy skills. And I actually was the interviewer for several of the diary participants and worked closely with the interviewing team. And we've worked to analyze those data. And we saw firsthand with this small group of people, so I can't generalize about the population, but from that small group of people, I saw a tremendous financial capability with limited means. You have to, right? You have to be very careful with your finances if your means are limited. So Brenda and I feel that overemphasizing financial literacy skills will have probably modest benefits, but it risks sending the wrong message that somehow you can do it yourself without recognizing the context in which people make financial decisions, including the pressures that people face, including the sociocultural, political, and economic things that they face. And we go into this in the book in more depth. When financial stress and anxiety are present, trauma-informed counseling approach is preferred. And I know we haven't really talked very much about that in this presentation, but that's another, I think, important result from our research. And I'm going to pass it back to Carrie now.
Wonderful. So we have one last question we wanted to pose to the audience. And we'd like to ask, what do you think are the most important means to assist Canadians with low income and reduce their financial vulnerability? Again, for this question, you can select all that apply, so one or multiple responses. First, financial literacy courses to teach basic money management, policy reforms to improve access to basic banking services, financial coaching to help individuals manage complex financial situations, strengthen predatory lending regulations, for example, reduce the maximum fee that can be charged, or any other means of assisting Canadians. And again, we welcome you to elaborate on your answer in the question box. So I'll close the poll in 3 seconds. 3, 2, 1. And actually, we have many people believe that a number of means of assisting people would be very important. So policy reforms, financial coaching, strengthening predatory lending regulations. And I'm looking at the comments now. We have, yeah, I think they're still coming in. Yeah, but actually in the meantime, we do have a question that we can pose to Jerry, and we have a request from the audience if we can provide a definition of bank's right to offset. If you can elaborate on that a little bit more.
I'm going to actually, it's Jerry, and I'm going to hand that over to Brenda. Brenda, would you be willing to answer that question?
Thanks, Jerry. Thanks very much for the question. The bank's right of offset refers to the bank has the right to take the money you owe it from your bank account without any notice. So if you owe $100 or $200 on overdue credit card payments, for example, the bank has the right to collect that money by drawing it out of your bank account. If you happen to have an automatic deduction from that bank account the following day, your bank account, if it is now overdrawn, will incur an NSF charge. So the bank's right of offset, just again, is the bank's right to collect the money that you owe it by drawing it out of your checking account. Thank you.
Okay, wonderful. Thank you so much, Brenda. All right, please keep the questions coming, and we will try to get to as many as we can in the later part of the webinar. So right now, we'd like to thank Jerry and Brenda for such an informative and thought-provoking presentation. You've highlighted for us the need to broaden the way that we define financial vulnerability in Canada, and this allows us to better address the everyday challenges of individuals and to consider the policies and systemic barriers that disproportionately affect those living with low and modest incomes. So I know that the scenario and the issues you shared resonated with many of our audience members on the line. And we'll give another friendly reminder for our audience members to direct any questions for Jerry and Brenda in the question box. And now we would be very pleased to hear from Margaret Yu, and she will speak to addressing financial vulnerability from a financial empowerment program delivery perspective. Margaret, we're so excited to hear from you. We'll turn the presentation over to you now.
Thanks so much, Carrie. Hi, everyone. I'm very excited to be here today. I'd like to introduce what financial empowerment work is. And as mentioned by Brenda and Jerry, that there's public policy, and we work in financial empowerment with a public policy lens. The second is a capacity building, so empowering community organizations to use financial empowerment as an intervention strategy. And finally, we offer programs and services. So we've been in the community for financial empowerment for 23 years. And just drilling down into that, we offer financial literacy workshops, live and facilitated or on demand to the public, to people who identify as Indigenous, youth, people living with mental health and or addictions. We also offer match savings, traditional, so in-person, in-class, as well as a savings app in partnership with a fintech company, and financial coaching. So those are some of the services we offer. And the outcome of our services is that program participants develop new skills, knowledge to move forward in their life that they want to live for themselves, their family, and their community. So I'm here to add more color to the presentation with the lived experiences of the participants and share a bit more. Next slide, please. So In the book, Table 6.2, The Barriers of Basic Banking Services to Canadians Living on Low Incomes, I just want to start with the slide deck around payments. So with monthly bank accounts fees, I've had a participant approach us and say, my goal is to find out where all my money is going and how do I save? So that was their goal. They didn't want to move their account because they had lots of bills that came through the account as well as income. And they had a good relationship with their financial institution. So we dug in a little deeper. They paid $4 a month for 12 debits. And they had at least 6 transactions come out of their account. So rent, internet, cell phone, renter's insurance, car payments, and so forth, which meant that it left 6 more times that they can use the account, which they went over. And when they went over the debits, it was $1.25, and Brenda earlier mentioned it was $1.95. So depending on the financial institution and what they set as their fee schedule, this person had excess debit transaction fees on their checkings account. So I'll total everything together. This person also faced social isolation, so they went to the bank often. They cared about their money. They were quite chatty. They wanted to know about what was happening with their accounts and so forth. So they went to the teller, or if the teller was closed, they went to the ATM to find out more about their account. So interim statements cost 75 cents. Statement updates from ATM, $1.25. They moved money into their savings account only shortly to move it back into their checkings account, and they're allotted a certain amount of movements from their savings account to their checkings account. And when they went over that limit, they were charged $2 per transaction. They had their paper statements mailed to them, so that's $3 a month. So totally everything together, it was $25 a month for this person. And their income was in the range of $20,000 to $25,000. So it was about 1% of their annual income. Just going towards banking fees, banking services. So when we discovered all of that for this individual, of learning more about the functions of their accounts, the costs, and finding sustainability, we were able to create a plan for them in Alliance and to move forward, to stay with the account that they wanted, to stay with the relationship, but an acknowledgement to what was possible for them. So in order to stay within the 12 debits a month, they chose a more cash-based usage, which requires extra planning on their part and budgeting in order to track their expenses. So this individual was able to cope and manage with their goal of staying at the bank, finding out where their money goes, and then using cash and being able to set aside money for savings. This other individual, a lot of them would pay $18 a month for unlimited debits per month to their checkings account. And this $18 a month might not sound like much, but compounded over a year, that's $216. And over a lifetime of this is 20 to 30 years, a lot of money. So I want to just highlight those for some of our participants and their lived experiences. To the third bullet point, the non-sufficient fund charges and overdraft. Non-sufficient fund charges, as Brenda mentioned, can be $45 and some banks charge $49. I've had an individual who, again, had some non-sufficient fund charges. It included rent, utilities, insurances. It was their car insurance, term life insurance, their pet insurance. All 5 of those NSFs posted on the same day resulted in a bill of $249. So that's when they came to financial coaching. How do I manage this debt and how do I move forward? So through a coaching approach, we were able to approach the financial institution to talk about what was in their checkings account and what would have cleared, and certain expenses would have. And we were able to negotiate the non-sufficient funds charges down to a amount that the person thought was quite reasonable. And through their skills, knowledge, and confidence, they were able to pay off the remainder of the NSF. They set up a low fund alert on their account and monitor their account and use budgeting skills to manage and prevent from future overdrafts. And lastly on this slide, to talk about overdraft charges that I've seen participants pay $15 monthly for overdraft they may or may not use, but just in case moments. And I've seen participants use pay per use, which is $5 per overdraft. So pretend if someone had 5 overdrafts times 5 per use, you can imagine the cost there. So there is a 22% interest rate to overdrafts, and those are calculated on a daily basis. So I've had a person who approached me, and their goal was to balance their budget. So we dug into their accounts and took a look, and we were able to see that there was a mismatch of income and access to credit, which was the overdraft. So they paid interest and overdraft every time their check came. It bumped up the account to positive, but within 15 days, they were back into overdrafts again. So what we did and how we approached the work was we tracked their expenses, we identified their needs, their wants, used step-down principles. So essentially reduce some of the expenses and try to increase the income to, again, get out of the cycle of using the overdraft and put a stop to it. So those are some of the participant stories there. Next slide, please. And then on the flip side, these are the participant stories with the short-term credit usage. So some of our participants are repairing their credit scores, and they try to access mainstream credit, but they're not quite there yet. So one example is a participant who went over her credit limit, and her credit limit was $500. So she went over it, and then she has to pay a fee. So through coaching, she found education that no more than 50% usage, and if there's an opportunity to increase her credit limit, that would be a possibility. Going over the credit limit hurt and damaged her credit score. As our participants are repairing their credit score, they access high-cost alternative financial services. And some of that, I'll just run through quickly because I'm already at my 10-minute mark, is access to a subprime auto loan. So some of our participants don't have access to liquidity and pay $5,000 for a used vehicle. Instead, they use a high interest rate or subprime auto loan at 38% in order to access their tool for work to be able to access a vehicle, so take them to and from work, or use it as to transport folks for work. So some of the folks would come to us in order to, after taking a subprime auto loan, to make ends meet. So we would work with them. Next is rent-to-own financing. We've had participants leased furniture with an annual percentage rate at 30%. And it made sense because in order to access a secure credit card, also at an annual percentage rate, it's 20%, but they had to pay an annual fee of $60. And they also had to pay $500 as a security deposit to access a $500 secured credit card. So with their rational thinking, it made more sense to lease the furniture because, again, there isn't that liquidity of the $500 plus the $60. So again, the lease furniture made the most sense. But the repercussions of that is rebalancing the budget so that they can make ends meet. An installment loan, I've seen a participant borrow $3,000 and then it ballooned up to $8,500. It was rolled over more than 7 times in 2 years. And that's almost 3 times the amount from the original loan to 2 years later. I'm just thinking about that. Plus, on top of all this is added insurance fees and administration fees on installment loans. Last but not least, participants use check cashing services. So provincial payments such as disability or income supports, they would sometimes take the check and go to a check cashing, pay a fee to access their funds. But with education coaching, you can go to a financial institution to access those or set up direct deposit. And there are folks who are unbanked who do use high cost alternative financial services in order to do their banking. All right, next slide. So the participants we work in coaching, they report that after 5 sessions that they feel they have a better control over their money management, more confidence, more financial well-being, and hope for the future. They're more aware of their options, other opportunities in the community, and they have a more positive relationship with money, and they feel very financially empowered. So my time is way over. I'm going to hand it back to Carrie. Thank you.
Thank you so much, Margaret. And before we move over to the question and answer period, we wanted to let our audience know that Brenda and Jerry have very graciously offered to give 10 copies of their book, Financial Vulnerability in Canada, The Embedded Experience of Households to attendees of this webinar. The first 10 people to email info@prospercanada.org with the subject line Financial Vulnerability book request along with their full name, phone number, and mailing address will receive a copy of their book at no cost. Available books will be given out on a first come, first served basis and will accept requests until September the 30th. So thank you again to Jerry and Brenda, and we look forward to hearing from those of you on the line who are interested in receiving a copy of the book. All right, so we move over to the question and answer period. And Margaret, I want to thank you again for sharing such like these examples I know resonate with many of the practitioners on the line who would see these cases with the people that they work with in their practice. And one question that's coming from our audience, we'll direct it to you, Margaret, is a comment around the difficulty of offering services or interventions like financial literacy courses to people and getting people to access them before a financial crisis happens. Because once that happens, something like financial literacy programs or workshops could feel like another barrier for the client. So how do you think we can bring clients on board more easily with financial literacy before the crisis happens?
That's a good one. I would redirect it back to the audience. I'm sure they have lots of examples. From the top of my head and from a personal perspective, I think a wide approach of systems approaching financial literacy. So whether it's at an early age in schools, in healthcare, doctors and nurses can prescribe a prescription to get your taxes filed, and so forth. Partnerships and recognition that reducing the taboo of talking about finances. It's a topic we don't talk about typically with friends or family or with a lot of folks. It remains very hidden. So openness to talk about it. And yeah, there's so many, but I'll just keep it there.
Wonderful. Thank you so much, Margaret.
Could I jump in on that one, Carrie?
Yeah, certainly. Please do, Jerry.
Well, thank you so much, Margaret. Your presentation was so interesting, and what a great question. And Brenda and I addressed this question somewhat in our book. And one of the things that we noticed in the Diaries Project is how people can become almost, I guess, ghettoized in certain kinds of financial services. And it could be because their community doesn't have very many banks. It could be because their family didn't have a tradition of going to banks. But what we saw was a situation where people have more of a tradition to go to a fringe bank, a payday lender, an installment lender, a check casher. Going to those types of institutions does not offer the potential to learn about other kinds of financial products. And so I think, I really appreciate Margaret's response to the question. The other thing I would want to say is that there's a long-term need for building equity in communities, across communities, and really drawing people into the mainstream financial sector.
That's very insightful. Thank you so much, Margaret and Jerry, for your responses. I think we have time for one more question. It was such an engaging presentation. We have many questions on the line. I want to remind our audience that if we didn't get a chance to get to your question today, just because we're almost at the end of the hour now, that we will be staying. We will reach out to our panelists to get answers to additional questions that have been posed to us, and we'll follow up with responses, and they'll be included in the slide deck that'll be emailed out in a day or two after our presentation. So please stay tuned for that. So our next question, maybe I'll direct this one to Brenda. So we talked about the poverty penalties and then the need for looking at barriers to access, especially in terms of banking. So are there currently any financial products or services that are available at financial institutions that can help alleviate some of these poverty penalties? We have a comment from an audience asking about things like no-fee bank accounts. Are these generally known or accepted by people living on low income?
Thanks very much, Carrie. Thanks very much for the question. It's a really important one. There are products that the banks are promoting as low cost or no fee bank accounts. Margaret, thank you so much for your presentation, because your first example was an excellent example of the shortcomings of the products as they're currently designed. My students tell me that the low-cost bank account for just their basic monthly expenses, excuse me, is more costly than the regular bank account, because they have to pay these per transaction costs above 12. So there are the low-cost products, but they're not meeting the needs of modest income Canadians, as far as we can tell. And again, Margaret's example, your first payments example, was as sort of named it exactly. Thank you very much for the question, and thank you, Margaret, for giving us the sort of on the ground perspective of that problem. Thank you, Carrie.
Thank you, Brenda. So we are getting close to the end of the hour. Time has just flown by so quickly. In the few minutes left, we do want to thank everyone for joining us today. Again, we will be following up with responses to more of your questions in our follow-up email. So that includes the slides from today's webinar, the link to the webinar recording, and also a link to a post-webinar survey that we would appreciate if everyone on the line has some time, take a few minutes to fill that out and let us know what you thought of today's presentation, what other topics you might be interested to hear more about in the future, and generally help us with making these learning events and continue to enhance and improve them. So we will post the recorded webinar on our Learning Hub platform as well. That is at learninghub.prospercanada.org/webinars. And this webinar is supported by the Investment Industry Regulatory Organization of Canada. We'd also like to let you know about an upcoming webinar. We hope that you'll join us on October 18th between 1 to 2 p.m. Eastern Time as we explore the topic of investor education and consumer protection with panelists from Fair Canada, the Ontario Securities Commission, and the Investor Protection Clinic at Osgoode Hall Law School. We will share the registration link in the question function right now of the GoToWebinar control panel. And also you can stay tuned on our social media channels and our website for further information about this upcoming webinar. We encourage you to visit the Learning Hub also to view a catalog of past webinars and a number of resources that are helpful for practitioners, advocates, and anyone working with low-income and financially vulnerable Canadians. The Learning Hub is updated regularly with new resources. And last but not least, some contact information if you wanted to reach out to us with any additional questions, comments, or suggestions. Please feel free to use the contact information listed here. Thank you very much again for attending today's webinar. We hope to engage with you again in October and have a wonderful rest of your day. Thank you so much.